Good afternoon. My name is Jeff Patton. I'd like to welcome everyone today for our inaugural Market Insight Luncheon. This is the first time we've had this lunch, which is exciting. I've got everybody up here winking at me. But we're going to start doing this. I think most of y'all get our Market Insight newsletter that we send out twice a year, one in the spring and one at the end of the year. So we're going to start doing these lunches twice a year. We're going to be filming the lunches, and we'll be sending out a link of the video with the Market Insight newsletter out to everybody here moving forward. So it's a good way for us to share the information that we're getting from everyone in this room and other people in the market and sending it out to all of our clients and friends. So we're excited about doing that moving forward. I do want to just take a second really quick and thank some people. We couldn't be here today without the hard work of a lot of people on my team. I'd like to say thank you to Ryan Dale, Bo Davis, Brian Fickey, Matt Como, and Emily Eckberger. Thank you all for help bring this together. And then I'd also like to welcome and thank our guest panelists today. We're going to have Brian O'Boyle, Herb Weitzman, George Billingsley, Creighton Stark, Anthony Fulco today. So we'll get going here right now. So real quick, I'm going to introduce Brian first. So Brian is founder and chairman of Newmark Dallas office. Brian has over 30 years of experience in the brokerage of multifamily housing projects. Since 1995, Brian has personally been involved in over $20 billion of multifamily land transactions. Very impressive. So Brian, please come on up. Next, I'd like to welcome Herb Weitzman. Herb is the executive chairman of Weitzman Company. In 1990, Herb founded the company, a full-service commercial real estate brokerage firm that now ranks as one of the largest retail-focused real estate service firms based in Texas. Weitzman leases a retail portfolio of approximately 44 million square feet and is responsible for managing more than 22 million square feet of retail and commercial properties here in the state of Texas. Next, George Billingsley. George started at the Billingsley Company in 2007 and was promoted to partner in 2012. George now serves in an administrative role, which he is responsible for portfolio management, development, leasing, and financing. The Billingsley Company has developed over 8 million square feet of industrial space in DFW, Houston, and the Chicago markets. George is also married to Lindsay, and they have 2 children, Davis and Grace. Please welcome George. Next, Creighton Stark, Executive Vice President at Colliers. Creighton is a leading veteran in the North Texas commercial real estate industry with 23 years experience. In 2010, he founded the office investment sales platform for Colliers International North Texas, which is currently ranked top 4 for transactions over 25 million, top 2 for transactions over 15 million. Creighton has amassed over $2 billion in total sales over the past 5 years, more specifically right at $500 million for 2021. Thank you for joining us, Creighton. Last, Anthony Fulco, Director of Acquisitions at MedCore Partner. Anthony is responsible for sourcing, underwriting, and closing of all senior housing acquisitions at MedCore Partners. Anthony has 10-plus years of senior housing and healthcare investment experience. Prior to joining MedCore, Anthony has held senior-level executive positions with Thrive FP and Virtus Real Estate Capital, where he oversaw and closed over $750 million of value-added senior housing. Thank you for being here, Anthony. Okay, so we're going to keep this pretty simple today. We're just going to have a just real easy format. We're going to ask each one of the panelists just to give us a brief overview of what they've seen this year so far and what they see coming up here in 2023. So I'll hand this over to Anthony.
Yeah, thank you, Jeff. I think I spend most of my time in the senior housing world, so our industry has been distressed really since March of 2020, obviously. COVID hit us extremely hard, and inflation hit us immediately in April. We've been fighting labor, we've been fighting food, we've been fighting just about anything you can think of in the economy on the expense side. So I know I'm a little more of the boutique product here, and most of y'all probably haven't spent a lot of time in senior housing, but the amount of distress that's coming out in 2023 is unprecedented. We've actually acquired 18 properties in the last 3 years, about $500 million at MedCore, at the debt, assuming debt, and really the value add distress type of transaction. So I expect that to continue in 2023. We're getting calls now to take over debt and buying properties for a third of replacement cost right now. So we're positioned, uniquely to do that, and that's what I've done my whole career. And kind of COVID's kind of played right into it. So our distress has been there; it's going to continue to be there. And now the third part of it is really fighting the Fed, as I know all of us are going to talk about. So it's not good news. I hate to start on a sour note, but it is an opportunity, I think.
Thank you. Thank you. Okay. So happy to be here, and the Dallas industrial market is an interesting one right now. It's a very mixed picture. We're combating the high construction costs, as everyone else is, as well as the high interest rates, which are really precarious and difficult to contend with. At the same time, rental rates are the highest they've ever been in the history of Dallas industrial. The occupancy is 94.8% in Greater Dallas-Fort Worth, according to CB Richard Ellis. And so there's definitely some bright spots. Some interesting statistics here. There's 910 million square feet of industrial space in Greater Dallas-Fort Worth, according to CBRE. 65 million square feet under construction. And in the recent third quarter of this year, 10.7 million square feet delivered. And in that same quarter, 10.3 million were absorbed. So it's a remarkable time to be a landlord in terms of occupancy and rental rate. So a couple other high points here. Tenant allowance is pretty high these days. It's typically $10 to $20 per foot. So that's consistent with the construction costs being high. Some trends are that there's onshoring. There's a lot of there's a lot of hesitancy to have manufacturing in places like China. There's a healthy distrust, in my assessment, not to be political, but you're seeing onshoring come back to this country. Also, there's problems with the supply chain, and a lot of tenants are addressing those just by having more resilience and depth of inventory. So both of those trends work in favor of landlords as tenants demand more and more space. As we look ahead, a lot of people are pressing the pause on development on proposed projects, and so that referenced 5.2% vacancy, likely, none of us know, but very well might tighten because there's going to be less and less competition, and if demand stays relatively robust, I think that could tighten even more. So I could extrapolate a lot more, but I don't want to take up too much time. Maybe the last thing I'll say is just a lot of people are curious about the debt markets, and it's a bit of the fog of war at the moment, but I just locked in a loan like 2 weeks ago, so I thought I'd share briefly this comp, which might be enlightening. So we just did 2 build-to-suits in Lewisville, Texas at our Austin Ranch development, and we locked in a 10-year note with HIMCO, a Hartford company, and it was a 5.83% interest rate at 58% loan-to-value. So I think that's indicative of where things are currently. And the last loan I did just across the street from that less than a year ago was 3.5%. So it's certainly changed a lot in short duration. Thank you.
Welcome, everyone. I'll talk a little bit about retail, and retail follows population growth. And in recent tracking of the 10 best retail cities in the country, we have 4 of them. Dallas-Fort Worth, I'm saying, is 1. Austin, Houston, San Antonio, and that's where the population is moving, and that's where the retailers look, when they expand. From the standpoint of the market, retail is really very strong. Where in 2020 we lost 2 million square feet, went vacant, and this past year we've leased in 2022 we've leased 3 million feet absorption. So we absorbed that, and we had growth, and occupancy is at about a 32-year high in retail around the state. We operate in all the 5 cities, so Dallas is clearly the strongest one with about 210 million square feet of retail. And leasing activity, has been really good because with that 2 million feet, that has been was vacated, it's been absorbed, and it's brought a lot of new tenants into these boxes. A lot of junior boxes were vacant, and now, you know, we're looking at it and say, well, where's all the new space going to be? And there's not going to be any, or much at all. This past year was anemic with a little over 600,000 feet. We used to do 9 million feet a year of new space. In 2023, we're projecting a little bit over that, between 700,000 and 800,000 feet. And when you really think about it, you know, a lot of that square footage is anchor stores. I mean, H-E-B, who's building their stores, are counted into that number for next year. So that's going to be around 800. And so, you know, the silver lining is that, you know, existing retail is going to get better if it's a decent location, because the densification is going to continue. And through these last, you know, after 19, which was the high point, you know, the multifamily just continued to build. And so the retail that's been supporting that growth and the densification has really done better. So, you know, right now, Dallas is at an all-time high over the last 32 years at about 94.5%. You know, it's come up from 93.7. And so the opportunities in retail, you know, are pretty anemic because the numbers don't work with what the tenants want to pay or will pay for the cost. The cost has doubled since 2019, and the retailers is going to have to play a catch-up game. So where they're leasing is in the existing space, and you're not going to see too many of the big centers, community centers or power centers being built. Mainly, you know, the grocery stores, you know, aren't expanding, and they're a big anchor that proliferate the community center market, and they're putting their money and have put their money into digital, you know, and Kroger's into robots with their warehouses and delivery, and the curbside pickup has been perfected. The best one is by Walmart. You know, when you pull up and you put your order in, it takes 11 seconds for them to get the merchandise into your car. So we're really going to have slow growth in retail in the Metroplex. In fact, in Texas, even though there's going to be, you know, record growth of people because the cost of goods is so high, and the retailers, you know, you got this reverse 22 with the retailers not paying the price, and you've got costs going up of construction, and you have interest rates going up. So, but the market is really, really good right now, and retailers are expanding, and the market is looking real good. So I'll give you.
Great. On the multifamily side, the first quarter this year was probably a record for DFW. I think in my career, had the best career this first quarter, and most of the volume, you know, across the market was really done in the first half. You know, we went from in January of this year, Fannie Mae's rate was probably 3.73 for 10-year money. And then if you look at where it is today, it's closer to 6.25. So then we saw, you know, and it was like, it reminded me of, you know, going to bed at night and you wake up and you turn on the news and my God, in the last 45 days, we've gone from caps in the 3s to 5s. You know, we had one deal that we were marketing in North Dallas that just during a 45, this is probably going back 60 days ago, just during that marketing period of 45 days, the buyer saying, listen, I'm at about 375, and then 2 weeks later he was at a 4, 4.25, and then the REITs that were chasing the deal basically said, don't bring anything into us that's less than a 5. So we did have, you know, record in the last 12 months. You know, this market on the Dallas side did over 18 billion, which is the highest I think we've ever had. But the second half, the activity has come, I wouldn't say to a screeching halt, but there was, you know, pretty close to it. The interesting thing was that when you go from, you know, when you look at the market, typically you see such a dramatic downward shift. You would think that the fundamentals would correspond to that. You know, normally, okay, the occupancies are dropping like a fly, the concessions, but the fundamentals are still pretty solid. Give you an example. We had one deal that we had evaluated for a seller, prime deal up in North Dallas, new construction. A year ago, we told the guy, listen, we can get you out at 325. All I need is a CO. 325 CO. There's a pension fund that owned it. They couldn't sell it because they were sitting on too much cash. So then they called back 60 days ago and said, well, we need to sell it. And the difference was probably somewhere about $60,000 to $70,000 a unit difference between that year ago and today. You know, our pipeline, we probably lead the nation in starts. You know, we've got over 63,000 units in the pipeline. We'll deliver in the next 12 months, probably 32,000. Our absorption has been really good. I think one of the said, so right now today, you know, you've got such an impasse between a buyer's expectation and a seller's expectation. And everybody's trying to find discovery. Well, where is it? Where is the bottom? How much more is it going to fall? Where are interest rates going? So there's a lot of people on the sidelines. We've got the lowest level. I mean, we only have a couple deals on the market. And at one time this year, I had 55. You know, a lot of those cleared. We were lucky. They were first half. But, you know, that's an issue. I think one of the biggest things we're going to face, you know, and that a lot of developers are going to be challenged with is, let's say they started a deal 2 years ago. They had a 3-year construction loan. Well, at the end of that 3 years, they've got debt coverage ratios, covenants, that they've got to hit to get to that 1-year extension. And I'll bet you the lion's share of deals that are out there today, they're not going to be able to make that. The debt coverage ratios are not going to be there to enable them to do the, you know, to extend the loan. So that three years construction loan with 2 1-year extensions is probably going to be renamed to 911, you know, because there's going to be a big problem out there. So that'll be additional opportunities for other people. And when you look at what I see going on for the next 12 months, the deals that are going to get done are going to be deals of necessity. I can't get to my extension. Most of the developers, maybe it was closed-end fund with their equity, or the limiteds don't want to pony up. So a lot of the deals that are going to get done in the next 12 months are deals that are going to be done out of necessity. You know, rent growth. You know, we had such incredible rent growth in the last couple of years. You know, in the last 12 months, it was probably closer to just under 14%. Those days of that rapid rent growth are gone. That's why a lot of buyers were willing earlier in the year to take some negative arbitrage. So today, I think there's very few buyers in the marketplace that are going to accept any negative arbitrage. So, but it's going to take a while. The sellers are not willing to accept that I got to sell on a 5 cap. So I think it's going to be, the transactions are going to be significantly reduced next year. The other thing is to get construction debt. It's extremely difficult. Where before you could get non-recourse, non-repayment guarantees if you put 35% equity, and then today it's 50, but that's even if you had a lender that would be willing to make the loan at 50. I'm talking even if a guy's had done 10 deals with the same lender. A lot of these lenders are trying to figure out how much loan loss reserves are the Fed's going to make me put up on a lot of the existing loans I got, and then what's going to happen not only in multifamily loans I've got, but what's going to happen in the office building loans, and how much more am I going to have to put reserve. So they're kind of putting the brakes on a lot of the a lot of the new starts. So I think going into next year, I think we're going to see a significant reduction in the number of transactions, and the deals that'll get done will be done, a lot of them out of necessity. But the long-term outlook here, I think, is phenomenal. This thing is strictly triggered by one thing. It's just interest rates. All our other fundamentals are strong. We're starting to see a little bit of maybe increased, delinquencies, and maybe a little bit drop in the occupancies, but it's still over 95%. And this market long-term is probably going to be one of the best in the United States, and we just need to get through the next 18 months. That and $6 will get you Starbucks.
I'll take it. Good afternoon, everyone. So the office world is pretty interesting right now. To many, it's a 4-letter word, and it's actually a 6-letter word. So we'll start there. So office right now is kind of divided into 2 different areas. You got leasing and you got investments. Leasing is phenomenal right now, specifically in North Texas. Rental rates are higher than they've ever been historically, by as much as 50% from 10 years ago. We're at $30 on average, which we've never seen in North Texas. We also are experiencing just over 12 million square feet of positive absorption. We're the 4th most active in the country for positive absorption for any market, across all different types, whether that's gateway markets, secondary markets, what have you. So the fundamentals in North Texas are really solid from a leasing standpoint. We're continuing to see a significant influx of companies coming in from all over the world, all over the globe, for specific reasons that we all take for granted, such as cost of living, skilled labor, quality of life, no state income tax, all the reasons that we know. And so we're starting to see a lot more companies coming in than ever before, which we never suffered from companies wanting to be here in the first place. And then existing companies are starting to expand. The investment arena, on the other hand, which is the world that I play in, that's where you're starting to see the 4-letter word. And it's not really a fundamental reason in investments. It's not that investments are bad in North Texas. In fact, we're the 2nd most active investment market in the country behind Nashville and going into 2023 per ULI. And so that feels really good. The issue that we have is interest rates, which we've all are experiencing, and inflation. The cost to run office buildings is extremely expensive, and the disparity between the disparity between inflation and rental rate growth has grown even more significant. So the cost to run these buildings for TIs, LCs, et cetera, versus what the rental rates that you can achieve, there's been an even higher and higher delta. So what we're tending to see is more of a flight to quality, where your A's, kind of your haves versus your have-nots, can continue to push rates to compete with inflation, and to compensate for the cost of running these buildings and to achieve the returns that investors need to see in order to stay competitive in the in the investment arena. And so that's a big takeaway, I think, as far as that goes. A couple of tidbits that I can just tell you from 2022 that we've seen with the interest rate environment having had such a dramatic increase over the past 6 months, as values have changed by anywhere from 10 to 15%. And reasoning for that is investors are solving for the same levered returns regardless, but when interest rates push by as much as they have, by 300 and 400 basis points, so now we're seeing debt quotes anywhere from 7, 8, 9%, depending on whether or not that's fixed rate or debt fund bridge type lender. It changes your returns dramatically. And so the only give that you can find in order to transact is going to be in purchase price. And so that's what we're starting to see. So all in all, about a 10 to 15%, 10 to 20% decrease in overall values. I do feel that there is a light at the end of the tunnel. We had some pretty nice news this morning that J-PAL is going to limit his increases in interest rates going forward. We're looking at probably 50 basis points in December, and then all in all, by the time it's all said and done, we're hoping that it's only about another 100 basis points. So that feels really good, and at that point, it'll start to level out. The interest rate problem will hopefully go away, not totally, but limited, and we'll start to see more transaction volume. So I would say by the second half of 2023, we should see, not back to where we were, but we'll start to see a significant increase in transactions and the amount of opportunities out there. to take it, just one more thing too, before I hand it back over to Jeff. The flight to quality is a big thing right now. The companies that are moving to town, in a lot of cases, are recruiting young talent out of school. And so in order to retain and recruit new talent, they've got to be able to offer these kids or these employees a place to come to work. Something that we've also noticed in our research in Colliers, we have a really strong tenant rep division, and so we've reached out to some of our biggest clients to do a survey, is that whereas before the pandemic, about 80% of companies were going into the office versus about 20% that were operating more from a hybrid type model. Well, that's flip-flopped to today, post-pandemic. So it's about 80% going to a hybrid model versus 20% going to the office. And so what that means overall is that experience for the employees is even more important in the office. So your uptowns that have walkability and outdoor space are going to flourish versus maybe, say, your Central Expressway, Richardson, East Richardson submarkets that are probably going to lag a little bit. And of course, take the $6 coffee information for what it's worth, because I've certainly been slapped on the wrist a couple of times for speaking out of turn. But at the end of the day, that's kind of what we're seeing. Those are the opportunities we believe that are going to continue to stand the test of time. It's just a very interesting time. This is some uncharted territory, and from what we can see right now is that second half of 23 should be pretty promising.
I want to ask a couple questions, then I'll open it up to everybody else. But, you watch the business morning shows, and, you hear the word recession. And so a lot of people feel like, we're heading into a recession, and some people feel like we're already currently in one. And so I just wanted to get everyone's thoughts, if you don't mind. Anthony, I'll start with you. Where do you, are we in a recession? Are we headed towards a recession? Not to use a baseball term, what inning do you think we're in? And, when do you think we'll come out of this?
Yeah, look, spending is declining. The layoffs are increasing. I think if you're just looking at the headlines, adjusted for inflation, I would think we're probably in a recession. What does that recession look like? I think a lot of us think back to 08, 09, and that's the first thing that comes to mind. That was so much more, I think, than a recession. It was a housing crisis that really locked up liquidity. So how does it affect us? How long does it last? I don't know, is my question. I think we got way overheated during COVID. Obviously, they printed too much money, which drove demand too much, which has caused this inflation, and now the Fed's fighting it. And so the hope is that they level it out, and we go smooth through 23. Now with the interest rates slowing down a little bit, maybe we will see that. I can tell you from the senior housing world, the thing about a recession for us is the labor market has been so difficult for us starting in March of 2020. To give you guys an example, we were paying caregivers and frontline staff about $12 starting in March of 2020. I think now we're probably paying $17 to $18, which has a direct effect to our margins, to inflation, to what we charge. We're pushing rents this year 10, 12%, pushed last year at some of our properties 15 to 20%, which is directly causing more inflation. So for us in our industry, we're a need-based healthcare product, and so the demand isn't as fluctuating. And so a recession for us isn't the worst thing in the world if it calms the labor market, but that's just from our boutique product.
Yeah, I don't think I'm qualified to give a really sophisticated answer. I mean, so many brilliant people anticipate these things, oftentimes without accuracy. On TV, like you referenced, I watch the same shows, and when you look historically, it's interesting to see who was right. But I'm confident that Dallas will be an outperformer, and I'm confident that industrial will be an outperformer within real estate. So I do have those convictions. I don't want to pretend I have insights I don't have, so I couldn't comment too much on the other. I do defer a lot to Larry Summers. I'm sure a lot of you all watch him on TV. I found him to be very prescient in recent months. He's really predicted a lot of things accurately. And he thinks the terminal interest rate will be at least 5%. And then if you had a spread of like 200 bips on top of that, the all-in rate would be about at least 7%. So I think that doesn't answer your question, but I think it's interesting and it correlates. So yeah.
I don't think we're in a recession at all. We're seeing high employment here. We're seeing people lined up to move to the state of Texas and the big cities. We're seeing a huge increase with people spending. And what you see in a few segments that are getting hit, and it's capital markets related. When it comes to times like this, I like to read a lot and talk and hear what the top people in the country have to say, and I'll share this with you. A week and a half ago, Jamie Dimon was in town, and you read he's the smartest banker in the world, and he. You might have read his articles in the paper. Was at a dinner and a lunch with him, and we do a lot of work with Chase, and so I wouldn't miss a meeting with him if my life depended on it, because I look to him as the leader in the world, banking sector, but there are a lot of areas that he couldn't answer and didn't answer. I looked to when he talked about, be careful because there's a hurricane heading toward us. And he took a lot of heat because of that remark. But I got back last night with a few Dallas people. We were up at a symposium in real estate up at Chase Bank with every member of the managing committee of the bank worldwide that was there, and there's still questions they don't answer. They don't know how deep the recession is going to go. In this instance, where we are, they don't think it's going to be too severe. But one thing they said is that be careful what you do. Not that we're not careful, but we would take risk based on things going up and based on inflation, based on low rates, but that's changing. So the bottom line to all this is be sure that you've got a ton of liquidity, because they really don't know, because we're in a war in Ukraine, we're having food shortages around the world, we've got oil shortages around the world, we could end up in a war tomorrow. And these are the things they're thinking about, and things that we should be thinking about when we're out there working. However, we're insulated in this state with our laws, that right to work, and so many corporations moving here, and all the capital that is coming here. I sat next to at a meeting out in California, a guy that is in D.C. He was a lobbyist. Now he has a big fund there, but he's ingrained in all of the what happens in D.C. And he was telling me that he used to come to Dallas for some of his customers, and he'd be here half a day. And now he comes, and he hadn't covered them all in a week. And these are major hedge funds, major heads of corporations that have moved here, and so forth. So for from just where we sit, I think we're the tallest midget in the circus, and we're gonna, I think we're gonna be okay. So just, I think, put your head down, really work hard, do your best to figure it out, moderate your risk, and so I'll talk about one other last thing, and that's what's that's helped the economy. You know, the economy is usually based on how retail does. And today, you know, we have digitalized retail, and the retailers are doing better than ever with this convergence. And those that haven't, you know, converted, you know, we're going to have a problem. But I don't think we're going to, I think the majority of retailers have converted their over to their digital programs and the convergence, and their, you know, customer can buy anything they want, anytime, anywhere, and any place. And our sales are going up, and you see also a huge amount of benefit to the state treasury, you know, because of the sales taxes. So we've got a lot of money to spend on programs that are warranted, and there are a lot of good things that are happening here.
I don't think I'd say that we're in a full-blown recession, but, you know, we may be signs headed towards that. But I still think that, you know, overall, we're going to continue to see so much more in-migration of people, especially from the coast. And I think the more fiscally challenged that these other states are, it's just going to continue to drive more people, you know, more people here. But I think in terms of, you know, what needs to happen, you know, 90% of our problem is just the interest rate. So, you know, once we start to see, we're going to have to see the interest rates start to decline before we get back to any semblance of. I don't think we'll ever see in anybody's lifetime in this room that we're going to see 3 caps again. You know, but if interest rates continue to have a decline over the next couple of years, can we get back to somewhere in the 4s or something like that? But the one thing I would say, I've been through a few of these cycles before, you know, you go to these things and you hear so much gloom and doom, but, you know, like the old expression, he who is fretting about the door that just closed doesn't see the one that's just open. And then people can sit around and say, oh my God, this is going to be terrible for 18 months, what do I do? And then, you know, if you keep just dialing for dollars and talk to enough people, you'll find those deals that, you know, you'll find the deals maybe out of necessity that need to be, you know, done. But I would say that being in Dallas-Fort Worth is probably the best area in the country, and in the next 20 years, you know, we're going to be the first to come back. So,
Adversity creates genius, right? Roger Staubach. Okay, so no, I share your sentiment. We are not going into a recession, I believe. And the reason why is I believe the fundamentals are totally different than they were 10 years ago when we went into a recession. Corporate debt is lower than it was at that point. People are not living paycheck to paycheck. They're not over-levered. We had so many good years. There is a lot of liquidity. There's a lot more people with liquidity. And I think that's why we will dodge a recession this go-around. We're certainly walking a fine line. Interest rates, J-PAL's certainly not helping the story, but that will too come to an end. I'd much rather be in North Texas than anywhere else in the country, and that is a fact. We're always the last one in, and we're always the first one out, and that's a fact too. So it feels really good to be here and seeing what's taking place. You know, it's indicative with the number of companies that continue to come here. I think the rest of the world is starting to see what we have here, which is really special. You can be on, you know, both coasts within a couple hours. You know, we've got a great, very special thing here. And we're seeing it just specifically with a lot of our clients that are relocating from coastal markets, CEOs to North Texas, just for that very reason that we're the center of the country. We're the center of the universe. And, you know, that feels pretty good. So no, to answer your question, Jeff, I do believe that we will dodge a recession. We're not in a recession. And I think that things are only going to get better from here as J-PAL starts to level out on his interest rate increases.
Well, great. Thanks for those answers. I'm going to open this up to anyone that has any questions. I'll bring the microphone to you. Anybody have any questions they want to ask to the panelists? Surely one question. All right. Well, I'll just wrap this up and say thank you to everyone for coming today. Everyone in this room is a client, friend to us. We appreciate everyone in here. We can't be successful without you guys and gals. And so just thanks for coming, and really appreciate everyone. We are going to be doing a lunch in the spring, another panel with lenders, which will be interesting. And so be on the lookout for our newsletter, and we look forward to seeing you soon. And just really quick, I would like to get a couple of our escrow officers to stand up. Lisa, I want to just introduce Lisa Murphy really quick. I know not everybody gets to see the people that really bring these deals together, but this is Lisa Murphy. Next to her is also Stacy Taylor. Stacy, if you want to stand up for a second. Wonderful Stacy. Be nice to Stacy. And then our all-star over here, Mr. Bob Blanchard. So many of y'all work with Bob. He's been around for a while and has some great experience. So thanks everyone for coming. Happy holidays, and we look forward to helping y'all with any requests you have. Thank you very much.